Before we take a field trip to the year 1929, I think it would be wise to review what the economy of the 1920s looked like. Let's think back to what we have learned in the past few units of history class to see if we can piece together the puzzle of 1929 and figure out where did all of the money go. Let's start with what it was like to work in a factory. So think back to the industrialization unit, early 1900s, when Henry Ford pioneered a new, less expensive way to manufacture cars. The new method of production was called the assembly line, where each worker performed an assigned production task again and again. This assembly line revolutionized other industries as well. It enabled manufacturers to produce large quantities of goods more quickly. This was known as mass production, and it decreased manufacturing costs so that products could be sold more cheaply. Although in class we had focused mainly on the manufacturing of automobiles, Ford's assembly line method of production was soon used throughout factories all over the nation, not just to produce automobiles. Using his techniques, factory owners were able to produce large amounts of goods quicker and cheaper. This fueled the American economy.
Hey, dear Tim and Moby, what is the assembly line? From Dakota. The assembly line is a system that's used a lot for mass production in factories. Come on, Moby, I've got an idea. We used to make widgets one by one. The word widget, by the way, is a term that economists use to describe any device or contraption they're using in an example. It's sort of like gizmo or gadget. Anyway, turns out it's a lot quicker to make a widget when you split the job into parts and assign a worker to each of them. A conveyor belt carries the widgets from station to station. Each person on the line has a different job to do. One worker assembles the parts, another welds them together, and the third pounds them flat. So all the workers help to make all the widgets. That's right, Moby. Robots work on the assembly line too. These industrial robots get the most boring jobs on the line. They're fast, accurate, and they never need a break. Using an assembly line, the factory can produce more widgets each day than if they had each worker making widgets one by one. And the more widgets the factory can produce, the less they'll cost in stores. The other good thing about the assembly line is all the widgets come out looking exactly the same. The assembly line came out of the Industrial Revolution, a major period of technological advances beginning in the 18th century. Inventions like the steam engine made the manufacture of hardware, cloth, and even food more efficient. In 1901, the Olds Motor Vehicle Company became the first to mass-produce cars. 12 years later, Henry Ford perfected the process using conveyor belts to crank out a new car in just over an hour and a half. Nowadays, almost all cars, trucks, and tractors are made on assembly lines. In fact, assembly lines churn out pretty much every consumer product in your home, from your computer to your sneakers. Come on, Moby, we should be getting home. Moby?
Another thing that fueled the American economy was the stock market. Think back to industrialization when we spoke about big businesses and how running a business can be very expensive. The first thing a business owner needs to do is raise capital or money. They need this money to buy raw materials and equipment, to pay workers, to cover shipping, advertising costs, basically to pay for all of the expenses that a big business owner might face. One way that a company could do this and raise the capital they need is by becoming a corporation, or a company that sells stock or shares of its business to the public. People who invest in the corporation are known as shareholders, and they're actually considered partial owners because they're paying for the expenses of running that business. During periods of growth, or when business is good, shareholders earn dividends, which are cash payments from the corporation's profit. So, in simpler terms, because the investor had lent their money to the business, they're hoping to receive a little extra in return. If the company possibly fails, however, the shareholders risk losing the money that they had initially invested. That is because the corporation had used your investments to pay for materials, labor, advertising, but now that business is not going so well, that money is gone. That's why investing in the stock market can be a great thing, but it's also a risk at the same time.
What happened to the lemonade? Okay, but how do you expect to make money selling this stuff if you... Dear Tim and Moby, my parents are always talking about stocks. What are they? From Eldridge. Well, stock is the money that's raised by a corporation that sells shares of itself to the public. A person who owns stock is called a shareholder or investor. Oh, okay, let's back up. Incorporating, or forming a corporation, is one way to organize a business. Almost all the large businesses that you know are corporations. But small businesses can be corporations too. When you invest in a corporation, you buy shares of its stock. You trade your money for a piece of the company. So, owning a share means that you, as an investor, share in the money the company makes or loses and in the things it buys. If the company's doing well, making more money than it spends, investors' shares of the company become more valuable. If it's doing badly and the company doesn't make as much money as it spends, the investor's shares become less valuable. As a shareholder, you also own a percentage of the company's assets, things that it buys, like factories and computers and even other companies. Well, that's the funny thing about the stock market. That's the place where you buy and sell shares of different companies. The price of a stock is ultimately determined by what investors are willing to pay for shares of each company. And what the investors will pay depends on how much money they think the company will make in the future. Well, it takes a lot of research and knowledge to predict when a company will grow. When people make big money in the stock market, it's often because they buy shares in a company when the shares don't cost much. This is usually when the company is new or not making much money. If that company grows or makes some more money, the same share that was worth pennies becomes worth a lot more. Right, buy low, sell high. You take a risk by investing in a company. It might pay off in the end, and it might not. Well, some investments are definitely less risky than others. A high-risk investment, like an internet startup, has the potential for making you a lot of money, or losing you a lot of money. Buying stock in a company that's been around a long time is a safer investment. The downside is that the established company has already grown, so you probably won't see a major change in your investment. Will I invest in your lemonade business? Well, it doesn't seem like you actually sold any, so I'm going to go ahead and say no. Well, never mind profit. Just to break even, you have to sell that last glass for like $10.
To encourage people in the 1920s to purchase stocks and to support business, they were offered the option to buy on margin. This meant that they paid only a small percentage of the price of the product and borrowed the rest of the money from their brokers. A stockbroker is someone who works at the stock market. Brokers, in turn, then borrowed their money from banks. As long as the value of stocks continued to rise, the buyer could sell later, pay back what was borrowed, and make a profit. But if the value fell, investors and brokers would not have enough cash to pay off their loans. This would be a bad situation. So let's say, for example, that you decided to purchase 1 share of stock in Edison Electric. The purchase price is $100 per share. You only have $40 at the moment, so you borrow $60 from your broker. Business is going well, and after 6 months, you are ready to sell your stock for $200 a share. After paying your broker back his $60 and subtracting the $40 you had originally invested, you would end up making a $100 profit. The other possibility, however, is that Edison Electric is struggling and the value of their stock drops significantly. As you watch the value of your stock declining, you decide to take a loss and sell your stock for $50 a share. Since you had originally invested $40 of your own money, it seems as though you have only made a $10 profit. But after paying back the $60 that you had borrowed from your broker, you actually have lost $50. As you can see, if you play the market right, there's a chance to make good money, but any investment is a risk. In order to complete the second half of your notes, you will need to view Part 2 of your simulation notes.